Hello everyone. When I made my last REIT video, I genuinely thought I already knew which I liked the best. Like in my head, the answer was very obvious. Then for this video, I researched all the REITs once again. Of course, with the help of LLMs. It's a tool I use for research purpose for all of my videos. Not one, but all five of them is what I've researched. Embassy, Mindspace, Brookfield, Nexus, and the new one, Knowledge Realty Trust. I slowly realized as I got the data that we have all been comparing REITs the wrong way, me included, up until few weeks ago. Because think about what actually happens when someone asks which REITs should I buy. They open the broker app, sort by dividend yield, pick whichever number is the highest, and that's it. But would you ever buy an actual company just because it pays the highest dividend today? Nobody does that. So I did something slightly unusual for a video like this. If I were evaluating these REITs for a long-term investment, this is the framework I'd be using. Not based on what sounds good, not based on some tweet or a video, but based on what's actually in these reports. Dividend history, dividend growth, how the stocks actually performed, occupancy, where the growth is coming from, the taxation, which is very important, balance sheets, the tenants which they have, what is under construction, everything. And honestly, some of it actually surprised me. There's a REIT here I was almost certain would come out on top, but it actually didn't. So, a very important disclaimer before we get into. This video is purely for investor education and is based on publicly available information from reports and investor presentation. And on this channel, we simplify investment products and share educational content to help investors make informed decisions. If you are looking for personalized investment advisory or financial planning services based on your individual circumstances, you need to consult a registered investment advisor. Now, let's begin with the number everyone checks first, the dividend, which I would call the dividend trap. Let's start with the easiest metric to check, and honestly, probably the least useful one too. Every single REIT conversation online starts with the exact way. What's the dividend yield? That's a fair place to start. Most people are not buying REITs hoping it will 10x. They want income, and there is nothing wrong with wanting that. But this is where I think a lot of us stop one step too early. Think about your salary. If your employer gave you a choice, 1 lakh a month forever or 80,000 today, but with 10% increment every single year, which one will you be choosing? That's basically the whole argument. Today's dividend matters, but it can't be the only thing you're looking at. But let's still look at how today's income compares across REITs. You can already see the numbers on the screen. What actually stood out to me is that the gap isn't that big. Some pay a little more, some a little less. But none of them are so far I would pick one purely because of today's yield. Maybe we have all been comparing REITs the backwards, asking the wrong question entirely. Instead of who pays me the most right now, maybe it should be who is likely to be paying me more 5 years from now. Because that's really where the money gets made. And that's what we'll look at in this video in more detail. The dividend growth test. This is the part that actually changed how I think about these five. After looking at today's dividend, I asked a different question. If I had bought this REITs 5 years ago, has my actual income gone up since then? Forget about what it pays today. Think about your own salary for a second. Say, your employer tells you, congrats, you're earning 50,000 a month. Great. Now imagine 5 years pass and you're still on 50,000. Would you be happy about that? Probably not, because groceries, school fees, insurance, electricity have all gone up. Your salary stayed the same, but it's worth less. Same thing happens with REITs or any kind of dividend investment assets that never grows its payout. The number on paper looks fine, but inflation's quietly eating out into every year. That's the whole reason I think dividend growth matters more than yield itself. Not if you are in and out in a year, but definitely if you are holding for 10 or 15 years. So, which of these have actually grown what it pays out consistently? Let's look at those numbers now. You can see what I found interesting. Mindspace never really screamed for attention. It just quietly kept showing up. Every time I compared something, there it was again. And after a while, I actually stopped and thought, am I underestimating this Mindspace REIT? Its distributions have gone up steadily every year. 19 rupees, then 21, then 24. This is backed by decent occupancy and leasing, not one lucky year. Embassy story is a bit more complicated, and fair enough. Every office REIT had to deal with COVID and the whole work from home scare. If you only look at 1 or 2 years in isolation, you probably draw a wrong conclusion about it. But let's zoom out and you can actually see the recovery. Occupancy has been climbing back up, leasing has picked up, and distribution is also as following. FY26 distribution came in at 25.28 rupees per unit. up 10% year on year. Brookfield almost feels boring. And I don't mean this in a bad way. Sometimes boring investments make the best investment. Its distribution came in at 21.40 rupees per unit for this year, which is up 11%. Feels more like prioritizing the portfolio quality and keeping the balance sheet clean. Not a bad approach, just a different one. Nexus is generally tough to slot into a comparison because it's not playing the same game at all. The others own office towers, Nexus owns malls. So its growth is tied to how much people are spending, how many people are walking through, which brands are expanding. Their DPU grew 9% to 9.08 per unit. And then there is Knowledge Realty Trust, the newest one. I actually wanted to run the same test on this one too, but I couldn't. Not because it is doing badly, but it has not been around long enough. What we do know is 92% occupancy, in place rents up 7% year on year, and it's paid 4.74 rupees per unit cumulative since listing. It's a good start, but one good start isn't the same as track record because dividends are only half of it. Say you and I both earn the exact same rental income every year, but after 10 years, my buildings doubled in value and yours hasn't moved at all. Who actually came out ahead? Which brings us to probably the most important part of this whole video. Which REIT actually created most wealth? Let's forget dividends for a second. Say it's 2019 or 2020 or whenever each of these actually listed, and you put in 10 lakhs, not for the income, just because you believe Indian commercial real estate is going to be worth more down the line. And then you do the one thing nobody usually manages to do. You don't panic. You don't sell. You don't check the prices every other day. You just leave it alone. Fast forward to today. Which one actually made you the most money? Not dividend, not total return. Just the raw change in the unit price is what we will look at. One thing before we look at this though is a higher price doesn't automatically mean a better REIT. Sometimes the price runs ahead of the actual business, and sometimes the business gets better and the market just hasn't caught up yet. So treat this as one piece of the entire puzzle, not the whole answer. First thing you will notice, none of these lines are straight. If you actually read the recent reports, occupancy numbers have been climbing. Leasing has also been picking up and GCCs are expanding. Demand for good quality office space held up a lot better than people expected, which is probably why some of these stocks have done better than anyone predicted a couple of years ago. And what's interesting is that market isn't rewarding all of them for the same reasons. Let's take Mindspace. It's not just that the price moved, it's how it got there. Committed occupancy is at 95.7%. Consistent leasing, execution that didn't really slip. It's a business that just keeps going, doing the boring right thing every quarter. Embassy is the largest office REIT in India by area, 52.5 million square feet. And when you're already that big, growth just gets harder. But it's kept adding assets, kept leasing well, portfolio occupancy is at 90% now, and kept its biggest tenants around. Brookfield, again, felt more measured. The market tends to get excited about flashy growth stories, and Brookfield just isn't one of those. 93% committed occupancy, loan to value is around 32%, which is disciplined. Nexus, I don't think you should really be comparing this to office REITs because buying Nexus is a bet on Indian consumption, not office demand. Leasing occupancy in Nexus is at 97%. Footfalls crossed 137 million for the year. More brands are coming in, more people spending, malls turning into actual destinations rather than just places to shop. So it's a totally different story, but the same category. And Knowledge Realty Trust. This one was generally tough to score, not because the business is weak. Honestly, the portfolio is impressive. It's already India's largest office REIT by market cap, 46.5 million square feet across 6 cities, and 45% of its rental income comes from GCC. But it's just too new. One strong year doesn't tell you how something performs over long term. I like what I see. I just can't give it credit for a history it hasn't built yet. We have spent all this time on income and price and returns. But step back. What are you actually buying? Not a ticker, but buildings. Real ones with real tenants paying real rent. So instead of just looking at stock price, we should also look at the buildings themselves. That's really where the answer is. Let me ask you something. Forget the market for a second. Imagine someone walks in and puts 2 keys on the table and says, both these office buildings are for sale. Building 1 is 98% occupied. Companies are practically queuing up for space, and owner keeps raising the rent every 2 years. Building 2 has empty floors, tenants leaving, and the owners offering discount just to keep it from bleeding further. Which one would you actually buy? You already knew a building that's always full is usually just the better business. That's why occupancy gets as much attention for me in these reports. Knowledge Realty Trust is at 92% committed occupancy across 46.5 million square feet in 6 cities. But honestly, the bigger thing for me was the quality behind the number. Nearly 95% of its asset value sits in India's strongest markets, and about 45% of rental income comes from GCCs. Those are not back office setups tucked away somewhere. Those are long term strategic bets by global companies. And that's the kind of tenant which doesn't leave so easily. Then another question popped up, which is who is actually paying all of these rents? Because occupancy on its own doesn't tell the full story. Two buildings, both 95% full. In one, you have Google, Microsoft, Amazon, JP Morgan, and they have signed decade-long leases. In the other, it's mostly smaller companies on shorter agreements. Same occupancy number, but completely different risk sitting underneath. Across all five of these, one thing's obvious. None of them are renting to random small business. These are some of the biggest names in tech, banking, consulting, healthcare. Knowledge Realty alone has 450 tenants. Tech is the biggest chunk, and most of the rental income comes from multinationals. Embassy, Mindspace, and Brookfield have the same story. Big global names anchoring the biggest campuses. There's one more number that barely anyone talks about in any of the videos which you see, which is mark to market rent. Say your apartment's on rent for 25,000 a month, but every similar flat in your building now goes for 35. What happens the second your tenant lease is up? You raise it. That's basically it. Commercial real estate works the same way. A bunch of these REITs are collecting rent below what the market would actually be paying right now. So, as the lease renews, they get reset at a higher number without buying a single extra building. If you look at Knowledge Realty, they talk about meaningful upside here as leases roll over. Mindspace leans on the exact same lever, renewals and escalations doing a lot of work. None of this happens instantly. Lease will expire in batches over a long period of years. But it tells you that there is already growth sitting inside these portfolios that doesn't need a new acquisition or a new building. Just better rent over time. So everything up to now has been about right now. Today's dividend, today's price, and today's occupancy. But investing was never really about today. It's about where business is going to be in 5 or 10 years. If a REIT owns exactly the same buildings, charges exactly the same rent, and never buys anything new, how much can it really grow? Not a lot. So, I wanted to know where the next leg of income is actually going to come from each of these REITs. And turns out they are all doing this slightly differently. The easiest way for an REIT is just raising rent on to what you already own. Commercial leases have the same built-in escalations, and if market rents have moved up faster than what's contracted, the REIT gets to reset that lease way higher. I wasn't just checking today's rent for all of these REITs. I was checking how much room was left to push it up. Mindspace specifically has a decent chunk of embedded growth here, just from renewals and escalations before adding a single new square feet. The second lever is actually building more. Say you own a mall and there is an empty land right behind it. You don't have to go find another property. You just build another block on the land you already own. Lease it out and your income steps up again. This is where Mindspace started making more and more sense because they already have 5.4 million square feet already under construction, another 1.9 million in the pipeline, and it's the only listed Indian REIT with an actual data center portfolio in the works, about 1.7 million square feet of it. It doesn't guarantee anything. Construction will take time and buildings will still need tenants. But it's nice to see that kind of visible growth already sitting in the pipeline. Embassy's approach is different. It's not leaning on one lever, it's pulling several at once. A 6.2 million square feet commercial development is in pipeline in Bengaluru and Chennai, plus hotels, renewable energy, acquisitions, rent resets, all running side by side. For something already that large, that's genuinely hard to pull off, since growth only gets tougher the bigger you get. Brookfield felt much more measured. LTV is around 32% with roughly 50 billion rupees of headroom for future acquisitions. Some of you will actually prefer exactly that if stability matters more than your speed. And Knowledge Realty Trust actually looks the strongest on paper. A combined 9.2 million square feet between under construction and future development. That's a good combination on paper, but a pipeline isn't income generating building yet. So I want to actually watch how this gets executed over the next couple of years before I would actually get too excited about it. Nexus again, I think you have to judge separately. The real question with Nexus isn't about office space at all. It's whether organized retail in India keeps growing. More brands, more spending, malls becoming actual destinations. Nexus benefits directly. Not a better story than office REITs, but it's not worse, just a different bet. Honestly, the thing that surprised me most while putting all of this together was assuming the biggest REIT would automatically have the biggest future. And that's just not how it works. Before I get into the final rankings, one more thing. Something I honestly ignored when I bought my first REIT also. Taxation. Here's the thing. Say you and I both put 20 lakhs and we both get exactly 1 lakh back as distribution this year. Sounds like the same deal, right? Actually not. What actually reaches your bank account depends on how the distribution gets taxed. And REITs are a bit unusual here. The payout isn't just one type of income. It's a mix of dividends, interest, repayment of tax at the SPV level. And each of these is taxed differently. So instead of trying to memorize the tax rules, I just ask a simple question. If two REITs pay out the exact same amount, which one lets you actually keep more of it? Take Brookfield as an example. Its last distribution broke down as 54% of repayment of shareholder, 29% interest and 16% dividend, and 1% interest income. That repayment portion is generally most tax-friendly part of the mix. Now every REIT structures this differently. Here is a complete breakdown which I have found online where you can see the different taxation and how your dividends get paid when you buy any of these REITs. I will also share the link from where I have got all of these information so that you can do your research on your own. I am not saying pick a REIT purely because of this. Tax rules change and your own situation matters more than mine. But if two businesses are otherwise pretty similar, keeping more of what you earn is actually a better way instead of having a REIT which taxes you more. And really, that's what this whole video has been about. Not chasing the highest dividend or the biggest building or even the highest stock price, but trying to answer one question. If I were putting my own money for next 10 years, which REIT will tick all of the boxes? So after dividend growth, capital appreciation, tenant quality and taxation, here is what I have landed. So here is how I would actually sum up each of these based on everything we have gone through. Nexus Select Trust, the consumption story. This one you have to judge on its own terms because it's genuinely not the same bet as the other four. You're not betting on the office demand, you're betting on the Indian consumption. More brands, more footfalls, malls becoming actual destinations. If that theme resonates with you, this is what it looks like in REIT form. If your thesis is specifically about office real estate, this naturally is not the fit. The next one, Brookfield India REIT, which is the disciplined one. Kind of like that student who never makes headlines but is quietly doing everything right. Conservative, financially sensible, clean balance sheet. It did not score highest on specific growth metrics. I weighted heavily in this framework, but didn't score highest on growth and a bad REIT are two very different things. The next one is Knowledge Realty Trust, the long-term bet. Genuinely, the hardest one for me to assess in this whole video. On pure asset quality, 96.5 million square feet, real GCC exposure, two experienced sponsors, one of the lowest loan-to-value ratios in the space. It's arguably the strongest on paper, but it's simply too new to have a track record, and I am not going to manufacture one. Worth watching how it executes over the next few years. Embassy Office Park REIT, the scale play. The largest and the oldest REIT in India by area and outstanding portfolio. Top tier tenants, a real track record through multiple cycles. It performed strongly across almost every category in this framework. This is what scale and proven history look like. Finally, Mindspace Business Parks REIT. This is the consistency play. What stood out to me evaluating this one was not any single big number. It was that across dividend growth, execution, occupancy and pipeline, it just kept showing up. That's what consistency looks like when you actually go line by line through 5 annual reports instead of eyeballing just one metric, like a dividend yield. None of these are better in some universal sense. They are different bets. Which one scores highest depends entirely on what you are weighing it on. You know what surprised me most? I started making this video because I wanted to find the best REIT. But what I ended up is realizing that's probably the wrong question. Maybe the better question is, what characteristics are you looking for in an REIT? If you're looking for stability, your answer may be different from someone focused on long-term growth. If you prefer retail real estate exposure, you may rank Nexus differently, and that's perfectly fine. Embassy gives you scale, Brookfield gives you discipline, and Knowledge Realty gives you potential. The video was never about telling what to buy. It was about showing you one framework for comparing Indian REITs. If you watch this and simply buy whichever REIT is ranked first, that will be completely wrong. But if the next time you evaluate a REIT, you should be asking these questions. Is the income growing? Is the occupancy stable? Does the portfolio have room to grow? Who are the tenants and what are the tax implications? Then, this video has achieved exactly what I hoped for. One final reminder, this analysis is for investor education and is based on publicly available information. It should not be considered as recommendation to buy or sell any REIT. I am not a SEBI Registered Investment Advisor. If you found this video useful, let me know in the comments. Which factors matter most to you when evaluating a REIT? I would love to hear your comments. Until we see in the next one, thank you for watching and have a good day.